Welcome everybody, this is Patrick Zielbauer from Infinity. Thanks for coming to the presentation today. Let's read some risk stuff and get rolling. Trading futures, options on futures, and retail off-exchange foreign currency transactions involves substantial risk of loss and is not suitable for all investors. You should carefully consider whether trading is suitable for you in light of your circumstances, knowledge, and financial resources. You may lose all or more of your initial investment. Opinions, market data, and recommendations are subject to change at any time. Past performance is not indicative of future results. Thanks everybody for coming to the presentation today. My name is Patrick Zielbauer. I do these presentations on Sierra usually every Monday. And this one we're going to talk extensively, hopefully, about volume analysis and how you can use volume analysis inside Sierra. So Sierra Chart, for those of you who are unfamiliar, is a charting program that we offer and support here at Infinity. It's a phenomenal program. Many of our clients use it. And if you're not sure about how we integrate with Sierra, if you have an account with us, we waive our fee for the charts, which is $19.95. We waive that fee if you do 10 round turns in a 30-day period. So it's a very inexpensive account to maintain. If you're considering using Infinity, Sierra is a great add-on. You probably won't pay for it anyway because the volume threshold is so incredibly low. But it's really a phenomenal program. And the purpose of these events is to try to focus on some general or specific topic of Sierra for an hour and get some questions answered, and that's what we intend to do here today. So volume analysis is a very, very big buzzword. It encompasses other buzzwords in the futures trading business like profile, order flow, that sort of thing is kind of like a hot topic in our business, there's no doubt. And so what I wanted to do today is show you some of the things you can do inside Sierra without having to buy add-ons from third parties or whatever. So it's not to say that doing that is bad in and of itself. But one of the things we like about Sierra is that if you have a vision, if you have some ideas that you would like to realize, you'd be surprised how much you can do inside Sierra without hiring a third party, to build it for you or having to, buy something from an ecosystem and that sort of thing. So again, going to third parties, getting education, not bad in and of itself. We just want people to understand the guts of what they're doing and why they're doing it, not just, buying an indicator and then having it not work out and then buy another indicator and et cetera. So that's a tough cycle to get out of. So today I would like to talk about a bunch of different chart books that I've got here. Some of this stuff might look familiar, other parts may not look familiar. One thing I want to mention now before I forget is any of the files that we are going to be showing in the presentation today, these are all yours. So if you want copies of them, just let us know. Just email your rep in our office. We will send them to you. There's no cost. There's no fee. All you need is a live or a demo account with us to make them work, and we'll email them over to you. So this is the combination of the recording and the files themselves, this presentation. Hopefully you really get something out of this. And without further ado, let's get into it. So I'm going to cover each one of these in a little bit. There are some things I would like to mention now about the format of this presentation. I'm going to cover the things that I think are relatively important. If you have a question, feel free to ask me. I may or may not get to all of it because we have a very high number of attendees today, which is honestly kind of surprising for the first week in August, but we'll do our best. All right. Okay, so what I'm planning on doing is showing a couple of different chart files. I'm not going to show how to build each one of these. I'm going to focus on a couple of demonstrative things, but let's just go through each of them briefly, and then we'll go through some specific stuff. So this one here is a TPO profile, in other words, time price opportunity, otherwise known as market profile, which is what this is here, and a volume profile alongside of it. Okay, so volume profile is really the only study that can be really added to a market profile style chart. All right, for those of you who are unfamiliar, this market profile is built based on time, meaning how much time the market spent at a specific price level, whereas this profile here is based on volume, which is how many contracts traded at a specific price level. So they look very similar in this case. They don't always look this similar. This is what is considered to be sort of what's called a double distribution, where you have what appear to be sort of two distinct market profiles. That can often be created when the market trades at a certain area, then moves to a new paradigm and trades the rest of the session in a new area. This is a sample that anybody here can have. If you have, if you want access to something like this, or you want to go more of do it more of a deep dive into profile trading, this is a really nice basic file that doesn't have too much nonsense on it. All it's really got is the market profile and the volume profile, and you can look for those things to align or not align, and use that to, as you see fit. So I'm not going to spend a lot of time on this one here, but if anybody does want access to that, please do let us know. This file here is called the Value Area Breach Project. It's basically something that let me just tile this on the screen properly, that I use on a daily basis myself. It's something that I've been working on for a couple of years. I'm taking lots of input from my clients and prospective clients about it. But one way to use volume is not necessarily just, when you think volume, sometimes you think just this volume candle or a bar at the bottom of the screen. And that is actually not how you have to use volume. You can use volume in other ways. And one of the things that I like to look for is the value areas being breached to the up or downside. So a value area is the range between which 70% of the volume has traded. So as an example, if we look at the Dow right in the middle here, this is the value area high, this is the value area low. This means that 70% of the trading activity took place between these two ranges. And why do we look at these areas? Well, what I like to look for is the market to breach this value area high at the same time that an extreme level is being made on the CCI. So it's basically like the combination of the market breaking outside of a well-established range in combination with a traditional oscillator like a CCI achieving a level that it usually doesn't achieve very often and doesn't sustain for very long at all. In other words, it's kind of anomalous, these two things happening together. So an example of how you can incorporate volume into your daily trading activity is not necessarily to look for very, very quick spikes in volume, although we are going to cover some of that, but also how you can look at volume on a bigger level as a way to see if the market is breaching a range that has been very, very well established throughout the day. Okay, so here's a good way to think about this. Tonight at 5 o'clock Central, when the markets open up, a new session will start, right? And a new value area will immediately be created, and it will be calculating in real time. So as time goes on, it takes more and more contracts to create a new value area, because the value area is constantly measuring the percentage of volume that has been traded, and it's creating this range based on value area high and a value area low. And as time goes on, that value area can shift. So as you see on this Dow chart, see this green dotted line here, and it's kind of going up and down and up and down. This is where the value area was at the time that you see the candle created. And then this solid line is where it is right now. It's just kind of painted backwards. All right. Similarly, down here, this red value area, you can see that this is the value area where it was. This is where it was at this time, and this is where it is right now. So these lines are always going to converge at the end. And then this current value area low, 25,378, is being projected backwards just for clarity. All right. So a value area is important because you will usually see, especially if the value area is being breached in a later part of the session, that is very meaningful. And you will almost always see some kind of flurry of activity happening because it's the market breaking out of this range. And why is it doing that? Is it because of earnings? Is it because something else is happening? There's usually something that is causing that to happen. And traders look for anomalous situations. That's a great example of when you might see a flurry of activity that might interest you as a short-term trader, especially if you're into order flow and executing quickly. So that's something. This is something that I've made myself. There's not a lot of great examples here. It was a very slow day. Obviously, it was. I think there was a bank holiday in a couple of places in the world, and we didn't do a lot of business today, I don't think. So it wasn't a great day to look at these, but this is certainly an interesting way to incorporate volume because you're not using it in the traditional sense. You're not just looking at a volume bar at the bottom of the screen. Now, that being said, Sierra does make available several different ways to look at volume on a more traditional level. Similarly, they offer the ability to separate volume into bid and ask volume, which is really quintessential in the whole order flow discussion. So these are some studies that Sierra makes available that are just regular studies that you can apply to a chart if you're interested in any of these components. So you've got an ask volume study here, you've got a bid volume study, you've got a bid ask volume ratio, okay, which is going to be a positive or a negative number. And then you've got bid volume versus ask volume, which is showing you sort of a net, and then the difference is this little blue line that you see squiggling about. And then ask bid volume difference bars, which is basically ask volume minus bid volume, and it's going to either be a positive or a negative value. So these are all ways that people will incorporate or display volume, various aspects of looking at trading volume. All right, when we used to tell people add volume to the chart, it used to mean do this. It used to mean go to File, New Chart Book, or I have a little shortcut for that here. Open up a chart. I'll just open up the NASDAQ chart, and then we would add the volume study to the screen. Okay, like this. This is what volume used to mean, all right, in our discussions with people. This is not what it means anymore. Now what people are looking for is they're looking to separate the bid volume, which is generally bearish. Okay, that's like if you hit sell market on your platform, you are generating a bid trade. Okay, you are generating a trade that hits the bid, and it's recorded as such. So that is a bid volume, a bid side trade. And if you hit buy market, you are hitting the offer. You are hitting an ask trade. And it, again, is recorded as such. So what people who look at order flow are looking to do is they're looking to see basically how much volume is being done on the bid versus the offer, not just how much volume is being done in general, although that is sometimes also incorporated. So that is what these little studies do, is these little studies separate out the bid volume versus the ask volume, or they display one as a function of the other. So if you're trading in a short-term method, and you're trading something like the NASDAQ or something like crude or something that is especially thin, you might really care if the bid-ask volume ratio is reaching extreme levels. Okay, you might also appreciate this. This is a bit more of a visual response of the bid volume versus the ask volume, and we can test for these conditions to reach certain levels and then notify us, in some respect. And I'm going to cover a little bit of that now, but I'm not saying that no one's chart's going to look like this. These are just examples of the studies that are available. But what we really want to get into is how you can manipulate the chart without being a programmer to tell you when certain conditions are going to be true. And that is what I plan to ask everybody here for. So I want you to start thinking a little bit about the types of conditions you might be interested in as someone who is interested in volume in general. So start thinking about it a little bit, because I'm going to start asking you here really soon. All right. We're going to cover some of that here. Actually, I'm going to come back to this one in just a minute. This is what's called the numbers bars chart, or some people call this an order flow chart. This is, some people call it a bid-ask delta chart. All right, that's what we're looking at here. This particular study is called numbers bars. And the numbers bars study is kind of like a footprint style chart. Some people use that term. And what happens is when you add the numbers bar study by default, all you get is the number of contracts that traded at each price. And then you get a red background if it's a down candle, or a green background if it's an up candle. So you still have some familiarity. But if you click on the settings section and go into settings and inputs, you can change the text in the candle itself to something other than the volume. And the most common thing that people are looking for is either the difference or the delta between the ask and the bid volume, or they want to see them both. And that's this choice right here, which is bid volume versus ask volume. So if you just choose the delta, you get values like this. So for example, ask volume minus bid volume, if it's a negative number, then it's going to look like this, and that's going to come through as bearish. Okay, if it's a positive number, it's going to come through as bullish, and more than likely you're going to have an up candle, a green candle. All right, so that's an example of how you can show the difference. And the other way is to look at the individual numbers, the bid volume versus the ask volume, and there's a number of different ways to display this. I'll zoom in a little bit here so it's a little easier to see. But this is an example of seeing the bid volume versus the ask volume at each price. All right, now, in my opinion, all right, and this is just my opinion, when you start to look at a chart like this, you're getting very granular with the way you look at the market and making trading decisions. In my opinion, it's quite difficult to do this on a short term, unless you've got some other tools that are aiding you, because that is a lot of data to look at in real time, as an intraday trader. So what I like to go through or teach in Sierra is how you can look at these principles a little bit more in aggregate, like the total bid-ask delta of the bar, not just the individual price levels like this. And there are a lot of ways inside Sierra to see that sort of aggregate information without having to look at all these different numbers like this. So don't think that just because you're interested in order flow that you're going to be trying to read tape like this. Okay, it doesn't have to be like that. So we'll go through a couple of examples as well. All right. Okay, and then lastly, we'll talk about this one a little bit as well. This is an order flow example that actually anyone who's got an account with us or a demo account already has this on their computer. The name of the chart book file is 2018 order flow, and this is built into the program by default. This is an example with the green and the red background that you see of how you can use the color bar based on alert condition to test for a series of conditions and notify you when those conditions are true. So this is something I'm going to actually probably rebuild with us, with everybody here from scratch, so you can see really how easy it is. It also should be noted that the only study that this green background shadow is referencing is this thing down here at the bottom. So if you like the idea of a nice clean chart without all this other stuff on it, even without the numbers bar study itself, you can achieve a very similar look without all this nonsense on here. All right, and this is actually a pretty clean looking chart, but what this chart is doing is it's telling us when the bid volume, the ask volume, minus the bid volume is greater than a certain threshold. In this case, I believe it's 2,000 contracts. So when you have a number like 5,000 here on a 15-minute time frame of the ES on a slow day like this, that could be argued as meaningful, and that could be a situation where, okay, maybe we're about to see something, set in motion. And in this case, that turned out to be the case. It doesn't always work that way, but in this case it did. Similarly, down here on this side, you see this negative 3,200 number. This test is being done, I think, at negative 2,000 contracts. So as soon as we hit minus 2,000, you're going to see this red bar happen in real time. That doesn't mean it can't go back the other way. It certainly could. You can also tell the chart to only notify you of the color with the color when the bar closes as well. So if you don't want to get signals intra-bar, you would have the ability to do that. All right. So I'd like to do a couple of examples about how you can do really basic alerts in volume, and then we'll try and get a little bit more into it with some of the questions that are coming through already. All right. Now, this chart here, there's actually two charts open. One is for crude oil and one is for the NASDAQ. So I'll just tile them separately, or tile them vertically on the screen. This one on the left is crude oil. This is a VWAP. All right, anybody ever heard of the study called volume weighted average price? Okay, this is another way to use volume. Now, this is, again, not an outstanding example, but what you're basically seeing here is the idea is that this price level of the current price level of 69.27 is what's called the VWAP, the volume weighted average price for the session. And a lot of people who use volume or look at this number as to act as sort of a magnet. And this is an example of another way that somebody could incorporate volume into their analysis that doesn't necessarily rely on what most people think of when they think of volume, like these bars down here at the bottom. But that's not really what I want to focus. I just wanted to show that because we do offer it and some people do ask us about it. But it's certainly something you can add. All it is a study called volume weighted average price, and then it can be configured in the settings and subgraphs just like any other study. So I have mine set to only display a couple of standard deviation bands, and it just looks a certain way, but you have the ability to customize that. This one here is where you can really get creative. So what we have here is a volume value area line study that is showing that value area high, value area low, and then the point of control. The point of control is the price at which the majority of contracts have traded in the whole session. And again, a lot of profile traders will use this value as sort of like a magnet, especially in a slow market. So one of the things you can do inside Sierra is you can have the chart notify you visually, when certain conditions are true. And establishing what those conditions are is, it's kind of it's a challenging act. But what you sort of want to think of is like, all right, if I had to describe in English an ideal scenario, what would it be? Like, what would I want to be notified of if, X, Y, and Z were happening? And there are a lot of things that you can do inside the charting program to spell out in in a language that Sierra understands, that you may think are very complex, and they're really not at all. So I added a study here that's called the color background based on alert condition study. And all I did was select a color, and in the alert tab, I've got a little code. All right, this is super easy. Now, when you look at something like this for the first time, even though this is actually a pretty simple example, do not be intimidated by the fact that this looks like a bunch of gobbledygook. All right, Sierra uses some really simple operators like V for volume, BV for bid volume, AV for ask volume, O for open, H for high, L for low, C for close or the current price. And if you know what those operators are, you can refer to them very simply in the program, and you can ask the chart to notify you when certain things are happening. So what I would like to do is I want to put up sort of like a naked chart, okay, something that doesn't have anything else on it. Let's just do a brand new one. And I would like somebody to give me, if possible, an example that incorporates some aspect of volume that doesn't require studies. So what this means is we can use volume, all right? We can use volume. We can use things like the high, the last, the close, the low, and we can refer to any other bar besides just the first bar or the current bar. So can anyone give me an example of a situation that they might want to test for? And while some of those answers come through, I'm going to show you how we can do that by ourselves. All right, so first thing I'm going to do is I'm actually going to remove the volume study at the bottom of the screen, or just hide it for now, so we can't even see it. All right, and what I'm going to do now is add the color background based on alert condition study. The reason I added the volume study is I want to be able to bring it back to the front when we're done, so you can see, you can verify that what we're telling the chart to do is accurate. Okay, so color bar or color background based on alert condition. So just add that study. In the settings section, I can pick the color I want. Let's just do that light blue color. All right, it's easy to see. And here's an example of how we can test for a basic condition. So V for volume. So let's just say that I want to see when volume is increasing, say 3 bars in a row. Okay, volume is increasing 3 bars in a row. All you have to do is do V is greater than V with a -1 in brackets. This means that the volume right now is greater than the volume in the prior bar. So the -1 refers to 1 bar in history. Okay? And if we're going to do more than one condition, we just need to separate the conditions by a comma. So I could say, all right, the second condition is the volume 1 bar ago is greater than the volume 2 bars ago, comma, and then we'll do the volume 2 bars ago, 2 bars ago is greater than the volume 3 bars ago. So we have 3 separate conditions, and again, when you go through them piece by piece like this, all of a sudden the whole thing feels way less intimidating. All right, you're just doing it one by one. And if you have more than one condition separated by a comma, all you do is encapsulate the whole thing with a parentheses with the word "and" in front. And when you push apply, you're going to see an immediate response as long as the signal is accurate, or as long as the syntax is accurate. All right, so we've got that all in place here. Now, let's just bring back the volume study real quick so we can show and feel good inside that this is actually correct. All right, so we're looking for 3 increasing bars in volume, and you can see down here, for example, we've got 3 increasing volume bars. So once you learn to tell the trust the program that it's going to give you good data, you'd be surprised how clean the chart can look, because you can start to incorporate your different ideas into one condition like this, or one series of conditions. All right, so that's an example of just increasing volume. So if you trade a strategy that is looking for sort of like a increasing, build of momentum, and all of a sudden it really is something, you're waiting for something to really go, and that when that happens, you start to see spikes in volume for several bars in a row, you can incorporate this. Here's a 1 minute chart with the same thing. Okay, very similar. So if you're a short-term trader and you just want to know when we're starting to see significant increases in volume repeatedly, this might be a way for you to do that. And you don't even have to have the volume visible at the bottom. You could just let the chart tell you when the volume is increased 3 bars in a row. All right. Now, other things that you can do where you can get creative. So I'm going to duplicate this chart and tile these on the screen here. And let's go, let's get rid of this one here for now. All right, so this is the duplicate here on the right side. So one thing that Chris had mentioned is how to look for, it sounds like what you're saying, Chris, is you're looking for like an increase, a certain increase over average volume or something like that. And that's something you can do as well. So if you're looking for like a spike in volume, like the market is seeing a ton of volume compared to, let's say the last 50 bars or something like that, that is something you can do as well. All right, you can also do things like, the volume in the current bar is greater than 150% of the volume in the prior bar. So here's an example of how to do something like that. It's very, very simple, and really it's just, it's just very basic math. All right, the condition in this case might be the volume is greater than 1.5 times the volume 1 bar ago, like this. So this is an example of a very easy condition of the current volume needs to be greater than 1.5 times the volume in the prior bar in order for us to be getting a notification. Let's just do a slightly different color here. All right, well, this one's a little bit much. Okay, so that's a few too many signals. But if you bump up the time frame, it might clean up a little bit sometimes on the bigger time frames. Okay, and if it doesn't, you can increase the value that you're looking for. So with the NASDAQ, obviously it's a relatively thin market compared to some of the others like the E-mini S&P. It might work better on a deeper market, but you could also increase this value. You could say, all right, what if it needs to be 2.5 times? So we're really looking for a significant volume spike. This is an example of how you might do that. So the volume in the current bar is greater than 2.5 times the volume in the prior bar. In other words, you could argue that that is, somewhat of a spike. Okay, so that's one kind of cool way to do that. Another thing that you could do if you're looking for, if you want to go back further than, let's say, the bar prior or the 2 or 3 bars prior, where you're looking at a significant increase in the volume currently compared to, say, the average of the volume over the past, however many bars. All right, that's something you can do as well. I'm going to duplicate this chart. We'll tile these up on the screen again. All right, one thing you can also do is you can add a moving average of the volume. So I could say, all right, we're going to add a moving average. Let's call it a simple moving average, 50 periods. And instead of basing it on the main price graph, we're actually going to base it on the volume study. So let's get a volume study added on here. I actually took that off. All right, so we've got a moving average, but we're going to base the moving average on volume. We're not going to base it on the main price graph, and we're going to stick it in region 2, which is where the volume is. So I'll just make it a different color here so we can see it a little bit better, like this. All right, so this is a 50 period moving average of the volume right here. All right, now let's go on a 1 minute time frame. Wow, look at how that dropped off near the end of the day. Yeah, that's definitely a slow close. But this is an example of what you might do. So in this case, you could say, let's change this to, let's just say for fun, I just want to see what it looks like on a different market. Simple moving average, gold. Okay, so here's an example of, yeah, so the metal sold off a little bit into the end of the day. So this makes a little bit more sense. But let's say in this situation, you want to see when the volume in the current bar is exceeding the moving average of, this 50 period moving average of the volume. You could do something like this. So you've got the moving average, which if you look at the ID number of the moving average and the sum graph number is SG1. So ID1.SG1 is going to be how we refer to the moving average. All right, and we know the key for volume is V. So we could say something like this. We'll add the color background study. And we'll say, okay, tell us when the volume is greater than, let's say, ID1. Oh, let's just do a simple one. When the volume is greater than the moving average of the volume. Okay, so the volume is greater than ID1.SG1, which is how we refer to this line. All right, that's going to give us this behavior, right? Because the volume is frequently above that number. But what you could say is that, let's just say we want to know when the volume is greater than the moving average of the volume times 1.5. All right, it's going to thin out a little bit. And you can repeat this process until you're getting meaningful signals. And these are things that can be incorporated in the rest of your decision making, especially if you're the type of trader who's looking for like a breakout or a significant move instead of just like a slow plotting move. So finding your way out of a choppy market, besides just sitting there and waiting, one way to do that is to look for anomalous volume areas. And this is an easy way where anybody with no programming background can test for this. And you can test for it across multiple markets. So you could have this study, on 6 or 8 different commodities or currencies or index products that you trade, and be notified when those things are happening. All right, so these are examples of things that you can do that really don't involve lots of studies. All you have to know is the condition that you're looking for and how to tell Sierra how to display it to you. One thing that I've always really enjoyed about looking at volume, and this is an interesting concept as well you may have run across, is sometimes people will look for buying opportunities on falling markets with decreasing volume. Right? So typically volume is higher when the market is falling, right? So if you see the market break, but it's doing it on lower volume, there's a bullish case to be made. And an example of that, or how to test for that, would be something like this. So if we let's just add the volume study so we can see here, okay? And I don't know if we'll get any examples of this here today, but what we can also do is we can incorporate not just the volume, but also the close and the direction of the bars. So if I add the color background based on alert condition here study one more time, and let's say we're looking for consecutively lower closes, but we're also looking for consecutively lower volume. So for the color background study, I'll just pick a color. All right, let's do like this. And the code might look something like this. So we're looking for consecutively lower closes. So the close of the current bar is less than the close 1 bar ago. The close of the 1 bar ago is less than the close 2 bars ago. Okay, so that's the first part of our condition. Let's just put and put parentheses. So this is not really a condition. I just want to give us something to start with. All right, so we're looking for consecutively lower closes. So like this one here, we clearly have 2 lower closes. This one here, we clearly have 2 lower closes. So what we can also incorporate is we could also look for lower volume. So comma V is less than V negative 1. Okay, that means the volume is less than the volume 1 bar ago. And V with negative 1 in brackets is less than V with negative 2 in brackets. This means that we're looking for 2 consecutively lower closes and decreasing volume. So sometimes you'll get good examples of this. I mean, like this one, I mean, this is pre-market, so I don't think this is volume studies are not as effective in the indexes until after the open. But look at this one here. Like that's not a terrible signal. All right, the market has fallen, but it's done it on low volume, and immediately, there's a bullish case to be made for this market, obviously with the benefit of hindsight here. But this is the kind of thing often people are looking for, is they're looking for anomalous conditions. When the market falls, typically volume is higher. So if the market falls and volume is not higher, then maybe it's not a meaningful break. So this is an example of how you could take like an idea that you might have, or a theory that you might believe, or at least have some interest in, and translate it into something the charts can tell you. It's pretty neat. Like this in and of itself, I think, is worth the entire presentation. This is This is the exact sort of thing that we'd be looking for. All right, so not only are we looking for, an anomalous situation with, the relationship between a lower market and volume, but you might also incorporate a couple other things into this. Maybe there's a moving average here that's involved, or, some other study that you're looking for. All right, Caesar had a question earlier about big lots buying or big lots selling. So Sierra actually does have a study that's called a large volume trade indicator that you can add. I actually, I've looked at it a couple times. I haven't gotten that far into it. We did a short video on it at some point. I mean, typically, what I like to do is I look at things on the entire bar. So I like to look at things in a way where we're seeing the aggregate performance of the bar in terms of volume, not necessarily just at a specific price level. All right, that's a weakness of mine where I just don't feel I can get that granular with it, or my decision-making ability on that sort of time frame is not as good. But Caesar, if you're looking for a specific study that you can configure to do that, I would recommend looking at the large volume trade indicator. However, this does offer us a nice segue into, where was our other one here? Into this chart book file here that can show us how we can display notifications based on a dramatic imbalance in the bid volume versus the ask volume. All right, so let's use this one as an example. I'm going to open up another chart book here. All right, brand new chart book, and let's copy this chart book into it. So duplicate chart to chart book into chart book 20, switch to it, and now we're here. All right, so what this file is doing is this is using a study that's called numbers bars calculated values. Okay, numbers bars calculated values. That is this thing down here. So this is basically like a table format of different things that people who look at volume or bid volume or offer volume like to look at. The main one, the most important one, is the first line. Where you control which of these are visible is in the settings section under subgraphs for this particular study. So if you add the numbers bars calculated values study, you will go to subgraphs and you will see that there are a whole bunch of subgraphs that you can have visible. All right, most of these I have set to ignore. Most of them are set to ignore by default. There are some that are visible, but if we really wanted to clean things up, you could actually go to draw style ignore, and hide most of these. We actually don't need that many of them there. Really the ones we want are the ask bid volume difference, and then the high-low range I just had on there because I was trying to incorporate when I made this. We were looking for more of an extreme range in order to incorporate, but you don't have to have that. So I could say draw style ignore, and we're basically left with this. So already we have sort of simplified the look and feel of this chart. Now instead of looking at all these individual deltas in real time, what this system is looking for is it's actually just testing for this number down here. So I don't even really need the numbers bars study to be visible here. I can actually remove it and just go back to my normal candles. I actually don't even need the current or the volume profile either, which is on the right side, nor do I need the current price line, which is the dotted line here that just kind of moves with the current price. So if I remove all these things, we're left with a very basic and very clean chart that is not cluttered and is giving us a viable signal based on something very obvious like the ask volume and bid volume difference being this big. Now, what do you have to think about when you are incorporating these sorts of things into your formula? Let's look at the formula in and of itself here. If we look at the color background study, notice there's two of these. One of them is generating the green, one of them is generating the red. So if I go to the first one, go to settings, you can see that's the green one. Look at the code. All right, ID1.SG1 is greater than 2000. Okay, so what's ID1.SG1? Well, if we go to the numbers bars calculated values thing, we'll see the subgraph number for the first choice here is SG1. So there's really only one other study on the chart. It's not that hard to figure out which study this is. It's ID number 1, subgraph number 1. So when that value is greater than 2000, the chart is giving us the green background. Right? Conversely, if we go over here, it's the same thing except less than negative 2000. So if the volume delta is bad, to the downside, less than negative 2,000, which means the bid volume is way bigger than the offer volume, this is where we're getting this notification. All right, so things to think about when you're trying to do something like this are the following. Number one, what market is it? All right, if we add this, let me duplicate this study or this chart here real quick. Let's just duplicate it once. And let's say that I change the chart on the right to crude oil. All right, we're not seeing any of these reactions. The reason why is that look at the deltas down here. They don't, most of the time they don't come anywhere near 2,000, which is fine. I mean, maybe you want to be super selective, but you will generally find that unless there's an extreme move like this one right here, okay, which happened at 4:45 in the morning, big spike in crude oil, which I actually remember this morning seeing that. You know, this is a situation where you're just not going to get as many signals if you're using a market that doesn't trade this heavily. So the E-mini S&P, you need bigger numbers because you're just less likely, you're more likely to see, you know, a lot of volume traded in these products. Another thing that you want to really keep in mind is the time frame. Okay, if you're using a 1-minute chart, you might need to lower your values a little bit. So for this 15-minute chart of crude, let's go to studies and let's just experiment a little bit. Let's just take this volume, you know, maybe it needs to be greater than 1,000 or less than negative 1,000. Okay, so we just changed the study. There's 1,000. We're seeing another true condition here. All right, and then for the sell side, maybe we go less than negative 1,000. Okay, we're seeing one there. So as you loosen up the criteria, you're obviously going to get more signals. If you go to a really short time frame, you also have to reduce the delta that you're looking for typically. All right, now remember, look at this 15-minute chart here with the negative 32.53 at the bottom. This just means negative 32.53. It could have been like positive 500,000 contracts traded, which is unlikely in a 15-minute period, but it could be positive 500,000 and negative 503,000. So you're really just looking for the net, you know, the net number, not necessarily the, you know, the components that go into it. So you do have to fiddle with it a little bit. If you're trading a market like the NASDAQ, like crude, especially the NASDAQ, you know, the NASDAQ only trades, what, 200,000 contracts on a slow day, 247,000 today. You know, the S&P traded 770-some thousand, crude oil traded 480,000. So you have to take into account the deltas you're looking for based on the market you're trading and the time frame you're trading on. All right. So there's a question that came through when you check if the delta has increased by 1.5, is it possible to take into account whether the delta is negative or positive too, or positive as well? So did you mean like the volume and the delta, or it sounds like you're being a little redundant there with the question. So the question is, when you check if delta has increased by 1.5 times, is it possible to take into account whether the delta is negative or positive too? You know, I'm not sure I completely understand that question. I suppose you can test for both. I mean, if the answer is, can you test for both of those in the same bar, I'm sure that, you know, yes, I'm sure you would be able to do that. Chris suggests using, you know, the ABS condition, which is absolute value condition. That might be a way to do that. But yeah, that sounds like that's probably a good solution, right? Yeah, that might be the best way. Jeff says, Patrick, are you going to show more examples of the setups using the value areas? Well, you know, Jeff, like the value area chart book here, this one, there really is not much to this. The problem with the value area setup in general, for those of you who've kind of tracked me going through this for the last 1.5 years or whatever, is that I'm finding that it's very subjective, and it's really hard to teach people how to do this in a way that I'd have to devote my entire day to it every day, because this kind of a setup here is dangerous for a lot of people because it's counter trend trading a lot of the time. What that basically means is, you know, you're looking for a reason to go short when the market is breaching a value area high level, right? So there's a chance that you're in the middle of some pain for a while if you do that. I don't really think that there is a lot to explain about the value area project. I mean, basically, the initial condition is to look for the market to breach this value area high at the same time the CCI is hitting a 200 level. But there are very subjective reasons to also not take these trades. So as an example of that, Jeff, if the value area high is being breached in, say, 3 of the 4 indexes at the same time, don't go short the market, especially now. There was a time when I first started doing this where the market was just rallying. I ignored every single short condition, even though they look perfectly good. It's very, very contextual. If you're going to go short a market that is approaching all-time highs, you better have either deep pockets or a lot of guts. So I'm not. I would like to devote another event specifically to this, but there are certain situations that I have seen. A lot of it has to do with the market's relationship to other markets, like the presence of the yen, the bonds, and crude on this chart. They're here for a reason. So another example of how subjective this can be is when crude was at $40, which is where it was when I initially made these chart files, I would ignore any long if crude was making a new low, because sure, the signal on the chart, on the index futures chart, looked great. The market is ripping through the value area low. The CCI is hitting negative 200. There's a good chance it's going to rally back. But if crude was making a new low, every time crude went down $1, people lost their minds because they're afraid all the energy companies were going to, be through. So it was just ripping the stock market lower and lower. So there was a time where I would ignore any long if crude oil was down, or making a new low. But then crude oil started to rally, and I stopped paying attention to crude. So it became less relevant. And what I'm finding is that continuously happens. The relationship between the yen and the stock market, it comes and then it goes, and then it comes and then it goes, and then it comes and then it goes. And it's you have to really be involved in understanding the relationship between some of these key markets, particularly the indexes and flight to quality instruments like yen, bonds, and commodities that have an impact like crude. So yeah, it's a tough one. I mean, looking for confluence in the stock indexes is harder than ever right now because they're so out of whack. Dow's down a whole day and then barely peeks its head up above water, or you have days where the Dow is down and the Nasdaq's making a new high and the Dow's making a new low at the same time. That's just a function of the geopolitical environment, and so the subjectivity makes this setup very difficult to teach properly. It's almost like I have to be there, telling people what to do, or whispering in their ear, which obviously I don't have the means to do that. So I really like this setup. It's just you really have to know what to look for, and then you mainly have to know when there's a greater chance that you're stepping in front of a freight train. The simplest example I can give of that is if you're looking for a counter trend signal that is related to the value area. If all of the indexes are breaching the value area at the same time, instead of thinking about going short, maybe go long one. Go long one Dow and put a 60 tick stop in and risk $300 because you might be catching a rally that goes on for a while. Similarly, if the markets are all breaching the value area low, in a market like this where things are sort of feel like they're teetering a little bit, even though we keep making new highs, everyone is really nervous when we make new lows on the day. If they're all making new lows at the same time, instead of following the signal, which the signal is going to be telling you to buy one, you can almost argue go short one contract of something. Go short one NASDAQ and put a $400 stop in and see if you catch something that rips lower the entire day. The whole point of this strategy is the signals don't come very often. So you really want to get into a position, get to a decent position, get your stop to your break-even point, and then forget about it until the end of the day and see if you catch a runner. It's the only way that, in my opinion, that traders can pay for all the scratch trades and the mistakes and so on. You got to be able to catch one that runs the whole day every day. You can't trail the stop too tight. You really have to let it go. So it's I'm glad you asked that because it allowed me to go on this little tangent, but I think it's a relevant one, and I think that combining volume like this with the use of a traditional oscillator that is so easy to follow, like a stochastic or a CCI. I just like to use the CCI. It's a way that people can pinpoint a relatively anomalous event occurring. Value area being breached plus the CCI reaching that certain level. Okay, when that happens, let's look at the bigger picture and see, all right, is this going to be an idiotic move if I go short one? Well, if all four of the value area highs are getting ripped through at the same time, don't go short. But again, very subjective. So hopefully everybody gets some of that, something out of that. But for those of you who are unfamiliar, we'll probably do another event specifically on this idea, at some point here in the future. This chart book, if anybody wants it, just email your rep in our office and we'll get it to you. It's free, right? Let's see. Za says, using Sierra, we can see where each number's point of control is. Is it possible to highlight when the bar's point of control is within 2 price levels of the extreme of the bar? A sign of absorption. So basically, you'd be saying the high of the bar, let's say, minus the point of control is less than like 2 ticks. Something like that. Yeah, so that's right. Okay, interesting. Maybe let's think of how we could do this. I don't know. Is there a hang on a sec here. This is exactly how I learned this program, folks. It's just being asked questions like this, and then you really have to dig into it. So let me ask you this, Ta, what study are you using for the point of control of a bar where you can actually identify it in the subgraphs section? So I wonder if that is in what I'm wondering is what point of control volume. So point of control volume is here. I don't know, is the point of control in here? Point of control value. Okay. So ignore this. We just want to see the point of control value. I don't need anything else. No, you don't want the point of control volume because that's just the volume traded at the price. What it sounds like to me, what you're looking for is right. So what Za is asking, it sounds to me like, is he wants to know when the point of control is within a certain, like very close to the high or low of a bar. The problem, Za, is that if you don't use this way of doing it, you need to be able to refer to to that value to create your study, right? So let's look at a 3-minute chart here. Okay, so this is an example of, I think, what you're getting at. So in this case here, you've got a point of control value of 74.43.5, and you've got a low of 74.42.50, right? So your point of control is right here, right? And here's your low. So what you're basically, what Za is asking is he's asking to be notified when the point of control is near the upper or lower end of the bar, right? So one way to do this would be, let's bring up that color background study. So we've got subgraph number, I think it was in the 40s. Yeah, SG42. So on the high end, what you could say is, let's get the color background study up here. Yeah, the POC of the bar, not the profile. That's right, Gary. So I'm looking at the point of control of the bar. This is the point of control value of the bar, not the profile. All right. So as an example, let's just do a color here. So we could say something like this. So if the high of the bar minus the point of control, id1.sg42, is less than, and then what you can do, there's an operator here called tick size times however many ticks. So if the high of the bar minus the point of control is less than 3 ticks, then we get this behavior, right? Now, obviously, this is, thanks, Don. This is relatively, we'd have to test for this. But then what you could do is you could duplicate that study, and then you could say the absolute value, because if you do the low minus the point of control, it's going to be a negative number, right? So the absolute value of the low minus the point of control value is less than -3, then give us a different color. Or is less than 3 ticks. Okay, so it's definitely doable. I mean, that's actually, I've been asked that before, but that is a good example of, the types of things you can do in the program without, this doesn't require programming, it's just a little bit of syntax. So yeah, this is definitely something, I know you can fine tune it probably, but a lot of these data points are stored in the program. You just have to know where to get them. In this case, for an order flow people, almost everything you would want to know about data points about an order flow or order flow related data points are in the study called Numbers Bars Calculated Values. So you can get a lot of data about each bar outside of that or from that study. This is a good example of that. So, and again, whenever you're doing something where, like, you're subtracting, the low minus something that's going to have a higher value, you're going to have a negative number. That's when you can use this ABS operator. So that stands for absolute value, folks. So if you come up with a negative number, you put ABS, outside the parentheses, you're going to get a positive value. All right. Okay, well, I think that just fried my brain for the day. So we might leave it there, but I really appreciate the input. That was a tough one, and it actually just not that tough, but it took me a minute to grasp it. That's a really great example of how you can use this program in a way to display your vision, and hopefully everybody can make use of something like that. So what I'm going to do is rename some of these chartbook files, based on what we've talked about here today. I'll have them all ready for tonight or tomorrow morning. So if you want copies of these things and to work in conjunction with this recording, which will be up on YouTube and in our new website, chartingclub.com. If you haven't registered there, please do that. We're continuing to build that video archive, and we're getting a lot of hits on it. So please do feel free to do that as well. That's chartingclub.com. It's kind of like our sister website. So feel free to sign up there. And yeah, if you would like to take a look at this chartbook file, or any of the other ones, just email your rep in our office. We'll get them to you. I really do appreciate the feedback. These types of events are always challenging, because these sorts of titles, when you throw the word order flow around and so on, you attract people who have very specific requests, and it can be challenging. So that really helps. So thanks for your input, Za, and everybody else. Really appreciate that. I will close up the room for now. If I missed anything and you want to ask, now's the time. Otherwise, we'll wrap things up. All right. The website for the charting thing here is chartingclub.com. I'll put it in the chat box for everybody. Feel free to register here. We are continuing to build this website out. You can register. You get an email automatically. Click the email or click the link in the email. Change your password. This has nothing to do with your accounts. There's no private info here. It's nothing, crazy. It's just a database of, videos that we're building out for Sierra. So hopefully you're getting something out of it. All right. Yeah. Thank you everybody for coming. I appreciate it. I'm going to read some risk stuff one more time, and then we'll wrap it up. We'll see you next Monday. Everybody tell your buddies how awesome this was and how much you got out of it. We appreciate that very much. Referrals mean a lot to us. Really do. If you have a small group of people or people you communicate with and you feel they could benefit from working with a firm like Infinity, please let them know. Let us know. We'd certainly be happy to do some small group training as well. Chris, I don't have any videos about changing TOS script to Sierra. I work with a couple of third parties who do that for a living. So if you are interested in, working with someone who can help you or at least get you on the right path, I'd be happy to provide some contact info. Okay. All right, Mark. Yeah, thanks for the comments there. Arthur, appreciate that. Jeff, Caesar, everybody I missed, thank you so much. Michelle, everybody, thanks for coming. We'll see you next time. We'll see you Monday. And everybody have a great week. Okay, keep your head on a swivel. Don't let your guard down just because it's slow. You never know what's going to happen. And you don't have me standing behind your desk, waiting to slap you in the back of the head when you make a mistake. Okay, so keep yourself in line. See you next time. All right, folks, trading futures, options on futures, and retail off-exchange foreign currency transactions involve substantial risk of loss and is not suitable for all investors. You should carefully consider whether trading is suitable for you. In light of your circumstances, knowledge, and financial resources, you may lose all or more of your initial investment. Opinions, market data, and recommendations are subject to change at any time. Past performance is not indicative of future results. All right, folks, thank you. See you next time.